Hi everyone. Do you know what an RRSP is and how it works? If you don't, you're in luck. We're going to talk about that today. And after we kind of give some foundational definition of an RSP and how it works, what we're going to do then is going to look at a couple mistakes, well, actually 5 mistakes that I've seen that people make with RSPs. So, if you know about RSPs and how they work, well, hopefully this will be a bit of a revision and you can walk away with some beneficial information. So what's an RSP? Well, it's a registered retirement savings plan and a tax advantage savings plan that's available to Canadian residents, right? And the whole purpose of an RSP is to help individuals save for retirement, as the name suggested, registered retired. And how that works is because it has certain tax benefits. But one of the first tax benefit you're going to recognize once you start contributing to your RSP is a deduction. So if you contribute to an RSP, you can deduct the amount you contributed from your taxable income for that year. So if your taxable income for that year was 100,000 and you have contributed 20,000, essentially your taxable income has been reduced from 100,000 to 80,000 because of the 20,000 contribution is made. So essentially you would have reduced your current income tax liability, which potentially, depends on your situation, would allow you to get some type of a refund. So that's the first benefit, tax deductible contribution. And by the way, if you don't have to use the amount, you don't have to deduct the entire amount this year. You could leave it for another year where you deduct. Okay, and then we have the tax deferred growth. The benefit is once you've contributed to an RSP, the money in that RSP can grow tax deferred. This means you only pay taxes on that income when you withdraw it. Now, whether you have contributed interest, dividends, or capital gains when it's withdrawn, it's going to be treated as ordinary income. But a huge benefit is that, you could you got contributions in RSP at age 25, and you have that stay in an RSP for 40 years till you're age 65. It would have grown tax deferred that entire time, no taxes whatsoever. But when you do take it out at age 65, at that time you start to pay income and it's going to be treated as ordinary income. What's contribution limits? There's a way to calculate that, but quite frankly, I'm going to keep it real simple and say look at your notice of assessment. Your notice of assessment from the CRA will specifically tell you how much contribution room you have. I've sat with clients and they told me how much their income is, and you can do the calculation and all that fun stuff. But I never contribute without looking at the NOA first, just to make sure that we're all aligned, we're on the same page, and we're on the same page with the CRA, because your penalties for over contribution, right? Now, what happens to an RSP when an individual becomes age 71? At least by the end of the year, that individual turns 71, I say an RSP grows up and it becomes a RIF, specifically a registered retirement income fund. And at that point, you have a minimum amount that has to be taken out. Now, that amount can be based on your age or it can be based on your spouse's age. So if you have a younger spouse, what will happen is at that point, it will be based on your spouse's age. And if you're younger, then the amount will be lower. These minimum withdrawals, they increase as you get older. And so what you want to do is just pay attention to the amount. We're going to talk about that, how much that amount is in terms of your overall income, because it helps with just tax planning generally. And essentially, the way I look at this, my assessment is that, government has given you this great benefit, and they're saying, well, it's great, you have tax deferred. Here you have all this benefit of having your investment being tax deferred. But gradually during your lifetime, at some point, you're going to have to withdraw all of this, right? And so age 71 is the age that they said that has to take place. Now that we have laid some foundation, what we're going to do now, we're going to talk about 5 mistakes that I've seen people make when invested in an RSP. The first one is delaying contributions. I mean, you could start looking at an RSP when you're 60, 65, 50s. And it could be beneficial for that particular year, but if you've been making decent income over the many years, you would have lost that opportunity for compound growth. Because again, we're saying the money in a RSP grows tax deferred, so you would have missed all of that, right? So the big mistake I see is people procrastinate on contributions, or not even having the knowledge of an RSP, which is great that you guys are watching this, because now you have the knowledge of how an RSP works and the potential benefits. You can make decisions about that. So the first one is, procrastinate. What's the second one? The second one is people. And it's sort of related to the first one, is overlooking potential tax efficiency, right? And that is, people know about RSPs, but they decide that they want to invest in, say, just put it in a regular non-registered. Well, the challenge here is, if you're putting a non-registered and you're taxed every year, you would again lost out on a component factor, but you're also going to be paying more taxes. Generally speaking, if it's a consistent investment, and again based on your circumstances. But in most cases, what we're going to be looking at is a potential where you could have saved a ton of taxes over these years, but instead you've had it in a non-registered. So again, loss of compound. But the second thing is not being tax efficient by not taking advantage of an RSP. Next one is, okay, you're investing in an RSP, but you have just sort of, okay, I have some extra money, I'll just throw it in a stock, or throw it in here, or throw it there, without giving some thought behind it, and not considering a proper asset allocation. And not having a proper asset allocation in the long term, based on where you're invested potentially, that's going to affect returns, right? So you want to look at asset allocation based on your circumstances and make sure it makes sense. And it's going to be based on your circumstances, your age, your risk tolerance, and a host of other things. But if you're not looking at asset allocation, there's a potential challenge there. The next one is, if you have gone about and invested and you have the proper asset allocation. When I say asset allocation, it really boils down to three things. It's based on cash, it's based on bonds, which is essentially a loan that you give to either a corporation or to a government, and they pay you a fixed return, or equity, which is just stocks, ownership in companies, right? So those are the three type of assets as it relates to investment in RSP. So you may have gone about and done the right thing and have the proper asset allocation, but what happens is, over time you have not revisited that, so you forgot to rebalance, right? And potentially, based on your circumstances, that might expose you to higher risk based on market changes, based on your tolerance, based on your age, based on your circumstances. You should revisit that. A lot of times we put it in and never look back again. Well, you may want to, at a minimum once a year, revisit what you had in place. But these days, with everything happening in the global environment, financial, socioeconomic, everything else, we want to probably revisit that probably even more than once a year. But once you have the asset allocation, you definitely want to rebalance. And then the last mistake that I've seen, and again, there are host of mistakes that I've seen with clients, but these are like the top 5. The other one is not planning for a tax efficient withdrawal strategy. And the biggest challenge I see with retirees are this: they get to retirement and now they have all these different sources of income, and it becomes overwhelming, because initially they had one source of income. For most people that's a job, or even if you have a business, salary from the business, dividend from the business. Of course, you do have folks who have different business, more than one business, passive income, real estate, but generally speaking, a lot of people have one source of income, business or just a job that they have. And now they get to retirement and they have all these different sources of income. They have CPP, they have OAS, they have TFSAs, they have non-registered, they have RRSPs. And what most people don't recognize is that when you pull from an RRSP, it's treated as an ordinary income, and you will be taxed. And the whole purpose of having an RRSP is, again, you contribute when you're at your highest income potential, and you withdraw from that when you're at lowest income potential. And so what you want to do is have a strategy in place. And you don't have that strategy a year before, or 2 years before. You want some runway, at a minimum 10 years. I recommend longer, but you want to have some runway to start to structure your portfolio so it's most tax efficient. So for example, if you take from a TFSA, a tax-free savings account, that's not going to be taxed, right? So when I sit with my retirees or my pre-retirees, and we're planning what the next year looks like, what we do is we look at all the different sources of income, and we strategize on what's the most efficient way to pull income and still meet the amount of income that they need, right? So it's going to be tax-free. Some are going to be taxable, but if we strategize and work it the best way, we're going to be optimized from a tax perspective. So it's one thing to contribute and get the deductions. It's another thing to you get to retirement, and what happens in retirement? You're going to have a situation where you have this huge RSP with a huge income, and the whole purpose is defeated if you haven't structured this properly. So hopefully this was helpful. This is a foundational video about RSPs and just the mistakes that I've seen. Hopefully this was helpful. And if there is another topic that you'd like me to speak with, or you want me to go deeper into RSPs, you can always do that. There are many different benefits to RSP. You have a home buyer's plan, etc., etc. But hopefully this was helpful. And again, we love some feedback. Take care. Until next time.